Do not for any reason ever share your private keys, passphrases, passwords, or click suspicious links. Everyone all the time is trying to steal your stuff. So go slow and be careful. There's no point making all this money just to give it to a thief. You know, this is true. Don't do all that damn work to give your money to some douchebag trying to steal your stuff. And guess what? Everybody is trying to steal your stuff all the time. They're either going to steal your stuff through phishing, through scam links, through weird text messages, through man, they will be so clever. Be careful. Do not click links, man. And if you do, just look at the link, because don't assume that clicking it gets you to that same place. Sometimes they'll reroute that crap. So what you do is you see a link you want to do, just go type it in. You don't have to click it. Just go type it in. And come on, be smart. So the only thing worse than not making it is making it and then giving it all back to some thief. That's no bueno, bro. Anyway, okay. So I'm having to pre-record this because I don't know what situation at the airport is going to be here in a bit when I go. So to that end, we're going to talk mostly game theory today, because if I go through prices, well, it won't be accurate. If the whole market S's the bed between the time I push record and the time I push post, well, then you'd be like, this is terrible stuff. What I can do is I can look at different assets and tell you kind of what I'm focused on. So our look at markets today is going to be a little different. I am just going to go and I'm going to tell you, this is what because it's about to be, let's see, tomorrow technically is my dollar cost average day. So I think I'll probably do it on Friday instead of tomorrow. Let me think. No, this would be that day. Yeah. So either Thursday or Friday, I'll do some dollar cost averaging. Either way, I'm going to tell you kind of what I'm looking at. Now, this isn't me telling you to go buy something. I don't care what you do or don't buy, but I have done my 5 T's and I feel comfortable, at least for right now, until the information changes, leaning into these assets a little bit. But you got to do you. And you probably will hear, for those of you that are digital heavyweights, which is a private service that we have, which is like really in-depth, kind of more educational based content about managing money, being competent fiduciary and all that. There's a couple ways that we analyze things. First, we hope that everything that we're purchasing has the potential for use, utility, and wide-scale adoption. If it doesn't, don't buy it, because you don't need to own anything that doesn't have use, doesn't have utility, and doesn't have the chance to get wide-scale adoption, right? So that's like the main thing. And then you need the 5 T's. So again, if something satisfies the 5 T's, and I'm going to show you the 5 T's in a second, and you say, okay, cool. It satisfies 5 T's. Now what? Well, it needs to have use, utility, and hopefully the potential for wide-scale adoption. So you say, okay, great. Well, what are the 5 T's, man? Well, I'll show you. And there's 2 versions. There is the 5 T's, and then there's the kind of expanded version, which I'm going to show you that as well. So the first of the T's, team. So here's a great thing that I've been doing. Let me make this smaller. A great thing that I've been doing lately is I've been going and grabbing the white papers of the projects that I like, and I copy the abstract, and I use GPT-4. I've got it both on my phone, and I do the little subscription of like $20 a month. I take the abstract, I put it in GPT, and then my prompt is, please explain this to me as if I was an 8th grader using bullet points. And it goes, so that gives me a basic idea of, okay, what is the kind of the technology? Is it time related? That can give you an idea of timing and technology. But to really do the 5 T's, and by that I mean to look at the team, the timing, the technology, the tokenomics, and why does the token exist? Why token? then it makes sense to do a little bit deeper research. So hopefully you would have read the whole white paper, although you probably won't because most people don't, but you should have. Now, if you've read the white paper, or if you've even at least taken the abstract and abstracted the abstract in GPT, you're going to have a good idea of what at least what the hell the token does. So maybe why token will have been answered, maybe not, but go to CoinMarketCap and just look at the project in CoinMarketCap, right? And so, I mean, it really is, it's pretty simple. So you go, okay, cool. Let's go to CoinMarketCap. I have a little watch list on here. I think, what was this watch list? This was like an AI watch list, I think. I think this was an AI. This is a good example. I have like an AI and data watch list. And so on that list, you have, and again, I'm not telling anyone to buy anything. I'm just telling you this is what's on the list. Graph Token, Singularity, NetOcean, Fetch, Numeraire, ALI I was kind of looking at because I was curious about it, but I think it's a dumpster fire. NewNet, Matrix AI is definitely a dumpster fire. I'm going to actually remove that. That's a piece of crap. It's a spammy, garbagey, it doesn't matter. And then Hypercycle. I would also add on there, although probably not yet, Rejuve, Cogito, and then when Sophiaverse comes here in, we think mid-July. They're waiting for, they're doing code audits and things like that. So Sophiaverse is coming pretty quickly, but we don't have an exact date yet. I will announce it as soon as possible. Oh, also real quick, as it applies to Hypercycle. So I'm going to use Hypercycle as an example. There is news about to be released about Hypercycle, about a partnership that they have. That will be, I was told this morning that that's going to be by this time next week. So it'll be released. Anyway, you come here and you go, okay, what the hell am I looking at? Well, this just looks like charts and stuff. So like, how are charts going to help me? Well, I don't know, man. They will tell you a little bit about the price, but price is not what we're after. We don't care about the price is the very last thing we look at, right? Because that's when we're trying to make a value estimation. But now we can start learning about the project. So you say, okay, this is the price. Great. If you'd like to know where to buy Hypercycle, cool. MEXC, PancakeSwap, blah, blah, blah. Okay, cool. Yeah. But now let's get to the goods. Hypercycle is a new layer 0 blockchain. You think layer 1, layer 0 would be underneath layer 1. Yes. Yes, it would. Little bells should be going off. Like, wait a minute. Does that mean other layer 1s could sit on top and leverage Hypercycle the way layer 2s like Optimism, Matic, and all the Polygon derivatives and Harmony One, Arbitrum sit on top of Ethereum? Yes. Yes, it does. More bells should be going off. Oh, it's an inexpensive. It's designed for high-speed, inexpensive on-chain execution of microservices. Go on, particularly, but not limited to those related to AI. So this is an important thing that a lot of people miss. I'm getting into the weeds here about Hypercycle, but just not limited to. So Hypercycle was designed as a layer 0 to process AI transactions, but that's not the only thing they can process. Having a layerless architecture, a layerless, blockchain is kind of a colloquial word that everybody uses, a very generalized term. This is not a blockchain-based system. It's a distributed data system that's very, very fast, really high throughput, and doesn't have to rely on a ledger. And that makes it very powerful. Anyway, this is an overview of Hypercycle's design, which leverages TOTA IP, Internet Protocol, ledgerless blockchain design, the TOTA asset model, the Singularity Net proof of reputation system, and the applications of Hypercycle, such as Swarm AI, rating and rewards and media networks, decentralized payments, data transfer, computer processing, public and private chain interoperability. That's why it's a layer 0. If there was a reverse pyramid, anyway, I'm not getting into the weeds on this one. I do own a lot of it. I like it. But the reason that I'm explaining this one to you is because when you, on any of the assets that you are interested in, you can leverage CoinMarketCap to do your research. And so you say, okay, cool. Here are some other articles. how to read and analyze a white paper, probably important. Crypto debit cards, not important. So anyway, you can get a lot of information out of this. You can get news articles. And so this is basically how it works. For any project that you're interested in, you should start at CoinMarketCap. So between using CoinMarketCap and using the white paper itself, and then going to the websites of the various companies and doing a little research, you have a lot of material at your disposal, right? So you can go to, and then they have the websites. So here, look, you have the white paper. It's right here. You can just go, you can go to their website right here. Oh my gosh, I'm at their website, and it's their actual website. Okay. And I can learn all about nodes and all this kind of crap, which is good. Now, what if I say, I don't want that. I want to go screw the website. I don't believe in no dang websites. I want to go to their Twitter. Okay, cool. We shouldn't live on Twitter because Twitter is a cesspool, but I want to read the white paper. All right, bro, let's check us out some white paper. And then you know what you do? You take the abstract and you go like this. You go, okay, a novel, and you just copy the entire abstract. And you know what you do? You copy and paste it into ChatGPT. Oh, my session expired. And I'm not going to log in front of you guys. But anyway, I have it on my phone and I already did it. And okay, I'll show you. This was what ChatGPT said was, what is hypercycle? Actually, I can get rid of that. Okay. So all I did is took the abstract. All right. Hypercycle is a new way of using blockchain technology and distributed ledgers to support artificial intelligence. It makes it easier and faster to run small computer programs called microservices, especially for AI-related tasks, but not limited to AI-related tasks. Hypercycle combines a few different technologies to work together for really fast transactions. What I instructed GPT to give it back to me in bullet points as if it was teaching to an 8th grader, because, I'm basically an 8th grader intellectually. All right. It uses special computer programs called agents that collaborate to make decisions. Each agent keeps its own history and reputation. The agents work together in a network to execute smart contracts. Hypercycle can be customized for different applications like artificial intelligence, machine learning, rating systems, voting, payments, and anywhere that data needs to be distributed. It aims to make it easier for people to create their own smart contracts using a simpler programming language called Meta, METTA, which is something that you can look up if you want to really dig into. Anyway, the point to all this is you spend 5 minutes and if you do your 5 T's and you go to CoinMarketCap, you have the tools at your disposal to do the research for any of these assets. And that's where you've done your 5 T's. So I score each of the 5 T's. I give them each a few points. So basically the way I do it is I say, okay, each one of these is worth 5 points. So the team at Hypercycle, you can look through the whole thing. It's Ben Gortzel, it's Tufi Salib, it's Dan Tolliver. It's like all these really just people with giant, like enormous brains. Great. I like that because people that are really smart, I like to leverage that. So that's the team, and I would score that a 5, right? Timing. It's the year of AI, and they've been in this for a while. So the timing to me is a 5. The technology, well, it's hard to say. I mean, we are not AI scientists, but I like the idea of a ledgerless data system, a ledgerless disintermediated blockchain-based system that sits underneath a system that doesn't need a ledger. Well, then we've taken out the last intermediary. I like that. That sounds cool. So I'm all for it. Tokenomics. Now that's something you have to dig into and see if that makes sense to you. 2.1 billion and change. Why? Well, it takes 1,024 tokens to equal a node. There are 512 nodes in a master node. What's a node? What is it? That lets you participate and get paid to participate in the processing of these transactions. You get a piece of it. Owning the tokens lets you buy a node license. Owning a node makes you a participant in this network. The global network of AI compute. Well, that's badass. And if you're going to pay me for it, I'll take it. So there's another reason why you would be incentivized to hold, not sell the tokens. So again, you have to make these arguments for yourself. You can't be like, well, Nick says he likes it. It doesn't matter what Nick says he likes. None of that matters. What matters is what you think you like. So if you look at the team and the timing, technology, tokenomics, and then you ask yourself, okay, why does the token exist? Well, in Hypercycle's case, as this example goes, you need the token because the token has to be transferred to facilitate a transaction. This isn't a network where the token is taped on as a monetary boon for the founders. This is in order to create a transaction between any two nodes, this token has to be transferred. Does that make sense? That happens before it's even recorded on a blockchain. And the locality of nodes prevents against attacks on the network. You can't untransact a transaction. It's the beauty of it. It's delicious. Anyway, so to me, it's sufficiently answered enough. Now, if I get an 18 or better, it's investable. And what would put me over the edge? Well, after having satisfied the 5 T's, getting an 18 or better by scoring each one of those 5 by 5, I would say, can this achieve use, utility, and wide-scale adoption? Now, I'm not telling anybody that they have to have this as their system for analysis, as your system for picking the assets that you like. But you have to have some system, something, right? And your process for purchasing them is by way of dollar cost averaging. I mention this from time to time. It means spending your investment over a longer period or intervals, investing on intervals that are randomized. As I was saying earlier, I go every 5 days. So I take my money. Let's say I have $1,000 I can sell in July. I don't know why it does that. Every time if I move this computer if I breathe, if I do that more than once, it's going to say the microphone is off. Anyway, whatever, doesn't matter. Anyway, the dollar cost averaging strategy is, let's say I have $1,000 for July. I'm going to take it. I'm going to break it into 5 or 6 bits. It's typically 30 days in a month. Ergo, you would probably have every 5 days. That's going to happen on 6 intervals. So about $160, $170 per pop. You could do 5 days. You could go every 6 days, right? You could do $200 5 times, whatever it is. You take whatever money you have, it's not going to bankrupt you, that you're willing to punt into this market of illiquid assets on illiquid exchanges traded by sketchy individuals that are dubious and over leveraged mostly, and sometimes nefarious. If you're willing to do that, whatever money you're willing to punt into that market, meaning light on fire, then you divide it into intervals, and that's how you invest it. And that's the only way you invest it. Now, what you buy on those days is determined by your enthusiasm and your weighting in your own portfolio of those assets. Because you can buy all these things by fractions. You can buy a fraction of a 1 penny asset down to the millionth, and in Bitcoin terms, down to the 100 millionth, which is referred to as a Satoshi. So I urge people to use a dollar cost averaging strategy. Mostly they don't. Mostly they punt all their money in, and that's that. And while I'm not a veteran in the space of investing, I mean, I guess I kind of am. I've been investing since the 90s, late 90s, since I was like in high school. Well, actually, yeah, since I was in high school. So, you have to find a way to weight these things that make sense for you so that you can sleep at night. No one else can give you that. There's no system. There's no douchebag guru. There's nobody can tell you how to feel safe at night except you. Means don't get over your skis. Don't overinvest. Use some game theory and cognitive bias. Understand cognitive bias gets in the way of rational thinking. Use game theory when you're looking into the future, trying to imagine how long is it going to take for other people to catch up. And I think you'll be fine. And again, these are all things that we do in the digital heavyweights, but for those of you that just have no desire to do any of that, you're like, whatever. No, just tell me. I'm not going to just tell you because it doesn't work. You really need to build a system of fundamental thinking, a system for thinking, a foundation of thinking. And, you also need to understand the macro a little bit. We're not going to go into that today, but There. Okay, so that's basically how it works. Now, I have a further broken down system, which I'm going to explain real quickly, and that is this. I look at the cash as the runway the company has. Do they have the cash? Did they do a good raise? Have they raised money? Is raising money the only way they make money? Things like that. Did they do a successful token sale? Or like, I want to know the cash situation. How much runway before these guys crash? 2, value. Why does the company exist? What are they trying to do? Right? 3, the direction. That gets to the management team. This is just a reframing of the 5 T's with a little bit more detail on one aspect. The price aspect. Is it priced as valued or undervalued? That's all I'm looking for there. Is it, if it's appropriately valued, why would you own it? If it's correctly valued, unless the information changes, there's no meat on the bone. If it's undervalued, that's what I want. That's where your multiples are going to come from. You want undervalued assets where you see this and they don't. You're at the beauty pageant and because of the woke ass world that we live in, who's going to win the pageant. It's not going to be the blonde girl from Idaho. Not anymore. Those days are over with. That's 10 years ago. Now it's going to be the shaved-headed individual that is gender androgynous, and everyone is scared to pick a pronoun. They, them, ziz are going to win. Why? Just because. So if you can arrive at the conclusion at a beauty pageant of who's going to win, not who's the prettiest, because you're not there to determine that. You're there to determine who's going to win. You front run that vote. That's investing. Invest in who's going to win before the mass of idiots and dummies figures out who's going to win. And that relies on game theory. So that's where we make our value proposition. This is why game theory thinking is important. You do need to study it. We're going to do some game theory here in a minute. 5th, liquidity. Can I enter and exit the position? Well, that's important. I don't want to buy. If you can't get 100K into a project without affecting the price, it's illiquid, bro. And even if it goes way up, you can't exit. Oh no, we're not using bro anymore, buddy. It's illiquid, buddy. So now that may mean there's a lot of opportunity, but that still means that a lot of people are going to have to come. They need exchange listings. There's all sorts of things that need to occur before an illiquid asset is liquid and traded, things like that. Now, maybe that means you're really early, and that's great. But if you're really early and it's extremely undervalued, you may be buying an illiquid asset, and you have to think about that. Can you exit? Maybe not for a while. And then finally, is there any meat left on the bone? Right? Like, are you late to the assumption party? If you find an asset and you can get a 1x, I can get 120% out of it, 120 basis points. It's not all that exciting. Really? That would be not 120 basis points, because 100 basis points is 1%. So it'd be 10,000 basis. Still not that interesting. Like a 2xing something is not that interesting. Now it's cool. You're like, yeah, that'd be great. And on a lottery ticket or something like that, you 30, 40%. Yeah, it's great if you were traditional investing, but you're in a space where the multiples can be massive. So I think you should be reducing your thinking to assets that can do anywhere from, a 5 to a 50x. And you're like, that's ridiculous. These numbers are stupid. Dude, not in a space that's not formed yet. The crypto space and the AI space, and especially where they merge, that nexus, that is not a formed market. That's not even close. These are extremely illiquid markets. And AI is just now getting started. So you have a brand new, highly explosive space in the crypto space. Crypto assets, distributed systems, what have you. Disintermediated digital assets. And then you have an even more groundbreaking, explosive, actually disruptive space in the AI space. And you are putting those two together. And I think where that nexus of where they merge is incredibly important, especially if you want to make currency units. So look for things that can do a 10, a 20, a 50x. And if you're not finding it, then, you've got to reduce your expectations. You can't have both. You're like, I'm in crypto to get rich. Okay, cool. I'm buying Bitcoin. Well, okay, but you're not going to get rich off Bitcoin. You hopefully won't get made poor, and hopefully you outperform inflationary effects, the rigors of a market under deflationary money, debasement. Hopefully you outperform that. It's better than just indexing in, but you need multiples, my friend, multiples. You need X's, not ones and two. You need X's. I've had 3 or 4 assets. I'd have to check. I think I've had 4 different 100X assets. Well, Cardano also. So 5. I've had 5 different 100X plays by using 5 T's and just going through. So anyway, it works for me. You've got to figure out what works for you. This has worked for me. And so I'm trying to get wealthy. I'm trying to get that cloud city so that I can sit up top and watch the T1000s descend upon humanity and wreak havoc. Don't call it selling out. I call it buying in. I am long Skynet, bro. All right, let's switch gears for a second. I do want to talk about some game theory. Now, let me caveat what we're about to talk about because we're going to look at a payoff matrix. But when I'm talking about game theory, again, to keep it simple, game theory is the process of modeling the strategic interdependencies between 2 or more players in a situation containing set rules and outcomes. Game theory is used to analyze economic competition, economic phenomena such as bargaining. Mechanism design is the other side of it, right? Auctions, voting theory, experimental economics, political economy, behavioral economics. You start realizing game theory is kind of like the underlying formula for, I don't want to say competitive thinking, but definitely structured critical thinking. Looking at a situation and looking at the incentives and outcomes, right? Like even Charlie Munger said, you show me the incentives, I'll show you the outcomes, right? Looking at the incentive structure of individuals in a system and then being able to make these assumptions, like the assumption of rationality, the assumption of maximization. What is that? It's assumed that players in a game are both rational and will strive to maximize their payoffs in a game. Say, okay, what's a payoff? Payoff could be just getting home early, beating traffic, right? So payoffs doesn't just mean cash in your pocket, but time is money. Time is limited. We only have so many breaths on the earth. So you want to maximize that, right? You want to take the best full advantage of it. And I know that the sunlight is weird. It's beaming right off of this roof next to me. The plebeians that live next to me, their roof is blinding me. So deal with that light. I'll sort it out on the next one. Well, actually, the next one will be Live de Mexico. All right. And assumptions in game theory, like I just talked about. Okay. So based on that, I want to take you on a little bit of a ride, and we're going to talk about the traffic dilemma. And remember, when you're getting into this game theory stuff, kind of sit back, relax a little bit. Don't overstress yourself. It takes a minute to kind of wrap your mind around this kind of strategic thinking, but it's very important. So this is a payoff matrix, and this will make sense in a second. But essentially, now these can become incredibly complex. This is a simple one, but they can be incredibly complex. You have driver 1, driver 2. It could be you'll see Alice and Bob, Charlie. These names Denise. These names get used over and over. Alice and Bob is normally how it would work. Like Alice on top, Bob over here. Oh wait, that gets gross. Anyway, you know what I'm saying. Driver 1, driver 2, stop, proceed, pluses and minuses. This is a simple payoff matrix. You say, well, I don't care. Well, you will care. So we're going to talk about game theory and the traffic light. So let's use a common traffic situation to illustrate very basic game theory. And then we can kind of work our way through it. 1, consider a scenario where 2 cars are approaching an intersection with a 2-way stop sign. We're assuming these are countries. This is in a country where people observe traffic signs. All right. So the main theme of game theory in this situation can be highlighted as followed. 1, the players. There are two players, two cars, right? Car one, car two, driver one, driver two. What are the strategies involved? Well, each driver has two possible strategies. They can stop at the intersection, or they can proceed without stopping, which is more dangerous. Okay, what are the payoffs? All right, we're really breaking down the thought process. What are the payoffs? The payoffs are the outcomes or consequences of the driver strategies. So let's assume that the payoffs are as follows. If both drivers stop, they both avoid a collision and they reach their destination safely. So they receive a payoff of +5. Well, that's driver one, driver two, they both stop. Yes, takes a little bit of time, but you know what? They don't die. They both stop. One of them goes, then the other one goes. They both get home. No one dead. That is a success, +5 for each one. Well done, drivers. Well done. Now, if one driver stops and the other driver proceeds without stopping, the driver who stopped incurs a delay and reserves a payoff of -1, while the driver who proceeds without stopping saves time and receives a payoff of +10. They got all that time bonus. Now, you might look at the first box and say, wait a minute, I thought stopping would be a +5. The numbers I'm using here are just to illustrate the principle. To be really accurate, it probably should be +5, +10, because you still don't die. Neither one of you die in this situation. But it's not a good equilibrium because there's a lot of risk involved. You have a lot of things have to go right if one driver is just hauling ass through there for someone not to die. So I'm using +1, but it probably should be +5, +10. You get what I'm saying? You're just scoring the benefit, the stress or eustress, the benefit or detriment to both players. Does that make sense? Okay. So in this case, if driver one stops, but driver two proceeds, driver two gets a +10, driver one gets a -1. And you see that by the box right here. Yes, we see this. This makes sense. Good. Okay. Now, let us go and continue. If both drivers proceed without stopping, there is a collision. That is the bottom right box. And they both either get maimed, or their cars get messed up, or one of a litany of potential injuries. And that is a -10 for each of them. They crash. That's bad. Outcome. So when analyzing the outcomes of this game depends on the strategic choices by each of the drivers. It can be represented in a payoff matrix as we see below. Now, the Nash equilibrium. Nash equilibrium, you're going to hear that a lot in game theory. It's a solution concept in game theory where it represents a stable state where no player can unilaterally change their strategy to improve their payoff. So in this scenario, a possible Nash equilibrium is when both drivers choose to stop at the intersection, since no driver can gain a higher payoff by unilaterally changing their strategy without risking, death. So the Nash equilibrium is the first box, +5, +5. We both stop. Now, it gets into the question of this, if we would really dig in. This is a cooperation versus self-interest kind of a question. The scenario highlights the tension between cooperation and self-interest. They're kind of interdependent, are they not? Right. So if both drivers cooperate and stop, they both benefit by avoiding a collision. However, if one driver decides to proceed without stopping, they can gain a higher payoff, but it's at the expense of the other driver. So in summary, this traffic situation exemplifies game theory by presenting a strategic interaction between these two drivers where the different possible strategies, whether that's to stop or proceed like a douchebag, these payoffs they are associated with strategies that are determined by individual choices, but they are interwoven, they're interdependent, and they determine the outcome, right? So each one of them effectively can determine the outcome of both of them. So it's important. Anyway, the concept of Nash equilibrium highlights the stable state of the game, and especially the decision for both of them to stop. So the scenario also emphasizes this kind of constant trade-off between cooperation and self-interest in decision-making. There's a lot of interesting research about why gas stations on adjacent corners will price relative to each other, because they can compete, but they beat each other up. Although if they cooperate, we're not calling it collusion, right? We're not the FCC or the whatever, but if a certain amount of cooperation is mutually beneficial, and there's some Nash equilibrium state, which also for the third party introduces that price competitiveness, reduces the decision-making possibilities you might have driving down and seeing the two gas stations and going, okay, this one I can get to, this one I can't. I might have to make it a weird U-turn, crash into 4 cars to get my gas, but I'll just go to this one. So there's another set of games that can be implied against those decisions. Every decision can be reduced to game theory if there's one or more individuals. Every decision. So when you start thinking in these terms, it's very interesting the way you might reanalyze basic situations. And traffic is a great one because we're all exposed to it all the time. So I like using it. I actually did a thought process of like, what is the game theory in dollar cost averaging, right? It's a different payoff matrix, but it is pretty interesting to kind of think about, right? Like, so you have the players. Well, the player in the scenario are the individual investors participating in their market, right? In their investment market, whatever market it is. What are the strategies? Well, each investor could adopt different strategies when it comes to investing, such as lump sum investing or dollar cost averaging, right? Those are 2 different strategies. What are the payoffs? The payoffs in this scenario are the investment returns obtained by the investor over some specified time period. The longer you extend the time period, the better the returns are likely to be for the person dollar cost averaging. The returns can be positive or negative depending on market performance and chosen investment strategy. But some people buy at the bottom. Some people buy at the top. This is information you can't know till after the fact. So it's a known unknown, and you have to factor that, right? So what is the outcomes that you have to study? The outcome of this game depends on the strategies chosen by the investors in the market conditions. It can be, the guy that invested at the top of 2017 or the top of 2021 or the bottom of 2014, the bottom of 2019, maybe the bottom of 2023. So as you extend that time period out, you're going to see a lot of different performance numbers. What is the Nash equilibrium? Nash equilibrium might not apply directly in this scenario because it typically assumes a strategic interaction between players and you're competing just against yourself. But what you could do is you could say the player 1 of me lump sum invests all my money. I punt all of it in today. Or the dollar cost averaging version of me invests over time. And you could compare those over time intervals and see how you did. And so anyway, game theory is still relevant though in analyzing these investing decisions because it makes the decision-making process and the expectations very clear, right? Well, we can't control market behavior, but we can control our behavior as we enter and exit a market. Does that make sense? Okay. Risk versus reward. So the concept of risk and reward is pretty significant in investment decisions, as I think you would all guess. Dollar cost averaging is often used as a strategy to mitigate risk. And so you do this by spreading investments over time and you reduce the impact of the market fluctuations. So you don't have to guess right. It takes the guessing out. It reduces the punting, right? Investors tend to weigh the potential rewards of lump sum investing against the risk of poor market timing, right? If you lump sum invest and you get it wrong, you could have many years of getting your ass handed to you. That's just depressing. If you wait long enough, you'll probably be fine, but I don't want to wait long enough. I don't want to get beat up for a 4-year cycle. I don't mind getting beat up for 2 years, but 4 years, come on, bro. Anyway, the stability of dollar cost averaging reduces so much emotional tension. Timing and market behavior. Game theory is a way to help us analyze how investors like ourselves may perceive market behavior and the potential strategies of other participants, the A and B of ourselves, right? So if investors anticipate that others will adopt a dollar cost averaging strategy during market downturns, they might adjust their own strategy accordingly to capitalize on potential price movements. If you see dollar cost averaging across the market, which you don't because people are not so smart, but if you did, you would see the market smooth. You don't see the market smooth because you don't see this behavior. So in summary, game theory can be relevant to the analysis of your own investment strategies, including lump sum investment, dollar cost averaging, just blind gambling, dart throwing, finding a trained circus monkey to choose assets. Like anyway, traditional game theory concepts like Nash equilibrium may not directly apply in this situation because you're just competing against your own portfolio. But the underlying principles and the strategic considerations, they influence your own personal decision-making. And markets are complex enough that you don't need to add an exogenous factor of guessing. Like, you're already making so many guesses. You're already assuming so many things. Don't then add the guessing and assumptions of punting your money into the market and hoping that you pick the right day, the right month, week, or year. And so I think based on all of that, one thing that game theory has taught me is to reduce your emotions and smooth your decision-making. And the way to do that, to reduce the emotion in this market, is to have a dollar cost averaging strategy. And anyway, that was a derivative. But yeah, I would really think about how game theory is the fundamental, I don't know, like the very basic math, the algebra of decision making. And I think that's going to help you a lot. On that note, let's call it a day. Stay in school. Don't do drugs. Don't do anything my poor, insolvent, drunk, strung out on meth grandmother would not do. As you know, that is very, very little. I will see you tomorrow for Digital Heavyweights. For those of you that don't know what Digital Heavyweights are, well, aren't you lucky? Because I had AI record it for us. Do you want to get ahead? We have a program that really dives deep into investment management, game theory, cognitive bias, and the connection between cryptocurrencies, digital assets, and artificial intelligence investing. It's called Digital Heavyweights, and we do 3 private educational streams per week. You also get up-to-date news and research created by a team of writers and analysts that curate data from my personal investment portfolio. We do the heavy lifting for you. Join me and hang out with us Mondays, Wednesdays, and Fridays in the Digital Heavyweights. I'll admit that sounds marginally rednecky. I'm not sure why that is. I may have to re-record it. It's so rednecky, but whatever. Have fun with it. Tout à l'heure.